Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me are Sonesh Shenoy and Pavitra Parekh. And so far, it's been a quiet Friday morning. We opened in the red. Since then, we managed to pull back. We're trading in the green. But again, in the last 10 minutes, we have come off from the day's high. The Midcap index is absolutely flat. Again, you are seeing a bit of a choppy move coming through on the Midcap index as well. Banks are doing very well. So you are seeing an outperformance coming in from the banking index. The Nifty Bank is up 0.7, 0.8%. And one of the big contributors we've been talking about is HDFC Bank. It has a 30% weightage in the Nifty Bank. And that, once again, is firing for the banking space. So it's because HDFC Bank is doing so well, you aren't seeing a decline in the Nifty Bank. On Midcap IT, a flurry of earnings have come through, whether it's Mphasis, L&T Tech, Coforge. And the big takeaway is that unlike in large cap IT, where largely the performance was similar, barring a Wipro, HCL, Infi, TCS, all of them had a good performance. The performance on mid-cap IT has been very diverse. On one hand, you've got L&T Tech downgrading their revenue assessment, the guidance for the full year, but you've got a Coforge upgrading the guidance. Yesterday, it was Persistent strong. Today, it's Coforge, which is strong. But for those two, strong names in the mid-cap IT, you've got an Mphasis in L&T Tech under pressure. So the key takeaway is smaller the company, higher the revenue concentration, higher the client concentration, geography concentration. So if something goes bad in an uncertain environment, the impact on their revenues is a lot more, which is why the mid-cap IT performance has been very diverse. And I suspect that is something that will continue through the course of the year as the demand remains uncertain. Because large-cap companies, they have a diversified client base, right? Even if one company doesn't do well, one client is under pressure, it doesn't impact the overall top line to that extent, unlike in mid-cap IT.
Absolutely. And I think you got to sift the wheat from the chaff, right, in the mid-cap space. And it really stands out for me in terms of the performances that we've seen so far. Coforge's commentary today was very, very strong, and I guess that puts the spotlight back on many of the mid-cap companies. They said that this 22% raised guidance is conservative. They have very strong margin buffers as well, and that puts a spotlight on the rest of the companies that are coming out with their earnings. So you have Tata Elxsi that comes out with earnings on 25th of January. All eyes will be on that, and it has been a huge outperformer in the recent past. So let's see, of course, barring the kind of fall that we've seen in the last 1 year. Persistent Systems as well posts very strong numbers. The stock is up almost 10% in January so far. Cyient is 15% away from its 52-week high. It's had very strong moves ever since it came out with its numbers. So if you pick the stock right in the mid-cap IT space, you've sort of, made money in the last fortnight or so. Talking about large caps as well, I mean, in this week alone, Tech Mahindra is up about 5% odd. So definitely continues to be on our radar this morning.
Oh, absolutely. And if you take a look at, some of the gaining stocks today, actually for this entire week, a lot of them have been from the PSU space, right? So pull up a few of those stocks and you'll see something like a Coal India, Power Grid. These ones have seen strong gains for the week. So for the week, you have Coal India, which is up almost 6.5%. Power Grid is up 4.5%. ONGC has done well as well. And the HDFC twins continue to do well. So for this week alone, you have HDFC Bank, which is over 4% higher. HDFC also seeing similar levels there. We have already pointed out the banking stocks and some of the mid-cap IT names which are doing well. On the downside, it is all consumption. So those stocks will come up for you. You have Reliance, which is a little bit subdued ahead of its earnings. And then the Bajaj twins continue to be under pressure. So for this month alone, you've seen, these are the kinds of cuts that you've seen on the stocks. Bajaj Finance is down over 9%. Your Bajaj Finsa, which is down almost 13%. So this is a space that you should keep watching. But, also ahead of this weekend, you have lots to track, right? The Reliance earnings will come out. You have ICICI and Kotak, which are the other big ones to track as well. So that's what's going on with the market action and the cues. But let's get you our first corporate conversation on the show now. Polycab reported a good set of third quarter earnings. In fact, the company posted its highest ever third quarter revenue. It has also reported a healthy growth on the margin front compared to last year. So to discuss the quarter gone by as well as the outlook going forward, we're joined by Inder Jaisinghani, who's chairman and MD, as well as Gandharv Tongia, ED and CFO of the company. Gentlemen, good morning. Thank you very much for joining us. This is Pavitra. And Mr. Jaisinghani, if I can come to you first, like I was pointing out, the revenue growth has been quite good for this quarter. It's around 10% higher for this quarter. Can you tell us what you see for the full year, that is for all of FY23? And also, what is the volume growth that you've seen in Q3, if you can put that out for us?
Q3, our volume growth was more than 15%. And it is going good continuously. And I think so even fourth quarter we are going to do good.
Okay, and what is the kind of revenue that you would expect for the full year then?
Yeah, we are thinking at least 20% growth from the last year.
Okay, 20% growth over the last year. That's for FY23, I assume. Mr. Tongia, come in on this. It's been a very good quarter. So if you can break it up for us in terms of different segments. If there's a 20% growth in FY23, what is the outlook for FY24 and which are the segments you think could lead you to that 20% plus growth?
Thank you for having us. We embarked on transformation program Project Leap around 1.5 years back, and in that period, we had access to FY21 numbers. We exited FY21 at 9,000 crore rupees, and we decided that we have to target 20,000 crore rupees by FY26. And that is what we are doing. From 9,000 crore, we moved to 12,000 crore in FY22. In the current 9 months, we have almost done 10,000 crore rupees, and we are hoping that we would continue with this momentum. The momentum would be contributed significantly by cable and wire business, where we have market leadership position, almost 24% of market share. And FMEG business, which contributes almost 10%, is also going to register a fair amount of growth. So growth will come from both the business, cable and wire, as well as FMEG.
In the FMEG business, since you're saying growth will come from there, purely if you go by what you did in this quarter, there was barely any growth. I mean, in the top line, same time last year, you did about 340 crores, and this year it was absolutely the same, I think 342 crores. So there's no growth in FMEG year on year. And even on the EBIT side, the margins have actually fallen. So what makes you so confident that the FMEG business will, get back to a growth trajectory? And if yes, particularly for that business, what kind of growth are you looking at?
You are right. We are already a 1,000 crore franchisee FMEG business. As part of Project Leap, we realized that we have to carry out certain course correction, which is what are being done in the current fiscal. And on the strength of that, we believe that from next fiscal onwards, we should be able to register a fair amount of growth. We believe the growth would be significantly better than the industry average growth. And that is how FMEG will contribute significantly to this 20,000 crore ambition, which we have for fiscal 26.
FMEG restructuring, the course correction is largely complete and it should start driving growth for you significantly in FY24. Mr. Jaisinghani, talking about the cables and wire business, where you all said that you have leadership position. Just purely in Q3, you had a revenue growth of about 11.5% in cables and wires. But your peer, Havells, had a near 17% revenue growth year on year. Could you give us an indication of whether just in the near term, did you lose market share? And also, if you could talk a little bit about your margins. Margins expanded. Is this the new base to work with? Can margins improve from current levels? Go ahead, sir.
Margins are always going to remain 11 to 13% in the cable and wire business. But our business is going to grow because demand is good and we are increasing capacity and continuously that demand is coming. So I think so. This overall year, our growth will be very good in the cables and wires also.
And overall margins?
Yeah, margin will remain within 11 to 13%. Yeah.
No, this is cables and wires margins or overall consolidated margin?
Cables and wire margin.
And on a consolidated basis, sir?
Consolidated basis will be around about 11%.
Okay. And if you could tell us about your peer, Havells, having reported higher growth in the cables and wires business in the current quarter?
No, it will remain the same, I think so. It is not much difference.
All right, that is on the margin front. Mr. Tongia, if I can come to you on the exports, I think for the 9 months of this year that have already come through, your exports are up around 30%. Your export contribution has also gone up, right? Last time we spoke, you said it's at around 10%. Can you tell us what is the kind of revenue growth you expect from exports? And is there any kind of trouble that you're seeing in global markets?
Exports is going to drive our top line growth in years to come. We believe exports should contribute at least 10 to 12% to our top line. As I mentioned last quarter, that every quarter we are trying to add additional geographies. We have now significant presence in developed countries like US and Australia, and we are continuing with our efforts in identifying additional geographies. My sense is in the current quarter, which is the fourth quarter, we should be able to up the exports contribution and we should exit the year between 8 to 10% of top line.
But you should be able to up the export contribution to how much? It's at 10% right now.
Yes, almost 8% if I take 9 months as a base. And my sense is the fourth quarter, we would be able to improve the contribution and we should exit anywhere between 8 to 10% by March of 24.
Okay, 8 to 10%. I have to ask you a slightly larger question, Mr. Tongia. I was going through a Kotak report where they did a channel check about the industry itself, and they found that there's a sharp drop in discretionary demand. Perhaps it's also because of normalizing of pent-up demand. There's inflation, which is hitting household incomes as well. And, there is no expectation of a rapid turnaround in demand. Is that your sense too, that there is some slowdown visible, and could that put any hindrance to your 20,000 crore FY26 target on the top line?
So if we were to talk about only cable and wire business, I don't think there is any hindrance. We have a very active and strong demand. The private capex has improved. The government capex of 7.5 lakh crore, which was committed in budget, almost 60% of that has already been incurred by the government. The listed companies' capex commitment has improved. So we are seeing very strong traction as far as demand is concerned, whether it's coming from government, private, or real estate. On FMEG, there were a few pockets where there was some softness which was felt, but I don't think that's going to continue. And we are extremely confident on achieving 20,000 crore rupees of top line by fiscal 26.
Okay. Mr. Tongia, correct me if I'm wrong, but I remember post Q2 you had indicated margins of 11 to 15%. Are you bringing down your margin guidance, saying it's going to be at the lower end now?
So cable and wire, we have two product categories. One is cable, where the margin is generally around 11%, and wires, where the margin is generally around 15%. On blended basis, generally it is between 11 to 13% at the cable and wire business level. Okay. So your recollection is right, that we are continuing with 11 to 13% of EBITDA margin. As far as FMEG is concerned, if you remember, I had mentioned that between this year and FY26, our EBITDA margin will go up right to 10%. And because of that, the consolidated margin would improve slightly, and it would be hovering around 13% or thereabout in years to come.
So you're saying that there is no slowdown that you're seeing even in the B2C segment, because that's something that Havels had indicated to us as well, that the B2C segment is undergoing a bit of a slowdown. You're not facing any of that?
In cable and wire, there is no softness which we are witnessing. In FMEG, there are a few pockets where we have witnessed some softness, but this is not of permanent nature, and we don't expect that it would negatively impact our ambition of 20,000 crore rupees by FY26.
Okay, all right, we leave it at that. Thanks a lot for joining in and giving us an update, Mr. Jaisinghani and Mr. Tongia. That's Polycab. It's a market leader in the wires and cables business. It has over 24% market share, and they have a very aggressive, ambitious plans, 20,000 crore revenue target by FY26. Despite all the challenges, they don't see any slowdown in their business, and they're hopeful to achieve that. Let's slip into a quick break. When we return, Datamatics is the company on our radar. The management will be with us to discuss their third quarter earnings. Welcome back. We have another corporate joining us now, this time from the tech sector. Datamatics is on our radar on the back of the third quarter earnings. The company saw revenue growth of almost 8.5% on a sequential basis, while margins improved 80 basis points. To discuss this quarter and the outlook, we're joined by the Vice Chairman and CEO of Datamatics, Rahul Kanodia. Rahul, good morning and thanks a lot for joining in. Can you tell us, for the 9 months of this year, you've actually outperformed your own guidance. You've done about 17.5% revenue growth and you had guided for about 15%. So what has led to it? And by the full year, what do you expect? And even in FY24, what could the growth rates look like?
So for the balance of the year, we'll expect to maintain the 17.5%. In terms of what led to it, it's a combination of multiple things. We did have some price negotiations with many customers. That contributed to it. Partly the exchange rate contributed to it as well. And partly operational efficiencies and cost controls. So it's a combination of all these things coming together. Next year looks fairly robust. We are not seeing a slowdown in the market. We're not seeing a slowdown in deal flows. So therefore, I think next year should be equally healthy.
Equally healthy. FY24 similar to FY23 then? Growth rates?
It should be in the same range, unless something happens.
All right. So based on your current visibility, FY24 revenue growth rate should also be close to 15%, right?
Yes.
Okay. Can you tell us what led to the margin improvement of 80 basis points quarter on quarter? And 15.8, is that the base margin from here on?
Yeah, that is certainly for this year the base margin. Probably might even improve a little more than where it is. In terms of what led to it, as I mentioned, it's a mixture of price negotiations, the exchange rate, as well as operational efficiency, all of them coming together. And of course, a few new deals that we bought. We signed up about 13 new customers in this one quarter.
Okay, Mr. Kanodia, good morning and thanks for joining us. Just for your digital operations business, the margin has declined over there to around 19.5 from the earlier almost 23 that you had. I think you'd also guided for around 23 to 25. So can you tell us what went wrong over there?
Nothing wrong. We have a little element of cyclicality in our business. Q4 tends to spike. Q3, we ramp up headcount in anticipation for the business in Q4. So because of the ramp up in headcount and no commensurate revenue, you see a dip in the margin, but that's part of the normal cycle.
So in Q4, it should be back at that level, around 23 to 25?
That's correct.
Okay. There is a price hike that has come through at about 5 to 6%. Have you been able to renegotiate the price hikes? I mean, last time you had indicated to us that there may not be too much scope, but can you tell us what the way forward is?
Yeah, we have been able to renegotiate prices across the board with several customers, not all customers, and of course there's a range anywhere from 2, 3, 4, 5% to as much as 20%, depending on the projects that we're doing. So by and large, we've received fairly decent price hikes because, of course, all customers understood the current challenges and the economic situation that we're having. So, hyperinflation around the world, lack of availability of people, salary hikes, things like that. So they're all in the same boat, and therefore they were cognizant of that.
So will you be able to take more price hikes in the coming quarters?
Not in the coming quarter, perhaps some in the next year, but not for the balance of this year.
What percentage of your portfolio is covered with the improved pricing, ranging from 5 to 20%?
That is very difficult. I've not done that math, so I would not have that number.
Okay, but price hikes would be selective, or is it more broad-based? Just give us some broad indication. 30% of your portfolio is covered, or is it more than 50%?
It is broad-based, and I would say it's a little over 50%.
Okay.
Okay, Mr. Kanodia, just one final question. We've been talking to a lot of tech companies, and a lot of them have been talking to us about the furloughs. Can you tell us what you have seen in Q3, and where do you really see this going? Are you seeing any kinds of signs of slowdown right now?
As I said, we're not seeing any signs of slowdown. We're seeing business as usual. Furloughs not in India. We're seeing them more in the US. But I think those are these overhyped companies. Some of them, of course, are very good companies, but nevertheless overhyped. I think it's that segment that you're seeing. That you don't see that in the core industries.
So on digital tech, your margins were negative in Q2. You turned it around in Q3. Q3 margins in digital tech, if those graphics come up, is currently at 2%. I remember last time you told us that margins for this segment will be in mid-single digits in FY24. Do you hold on to that guidance?
That's correct. We still have another quarter to go, and we expect that 2.2% to go up a little more. And therefore, the whole year, we should certainly break even, but it will be in the mid-single digits by the year end.
So mid-single digits for FY23 and FY24 margins for, yeah.
They will improve. 24 will improve even further. We're taking several steps to improve that.
All right, we will leave it at that, Mr. Kanodia. Thank you very much for joining us and taking us through the outlook for Datamatics. That is the management telling us that they're not seeing any kinds of slowdown right now. FY24, in fact, should look as good as we saw in FY23. The margins also, perhaps there was a little bit of a dip right now on account of seasonality, but in the next quarter, that is in Q4, it should be back to their range of around 23 to 25%. So that is the management. We are going to get into a short break now, but as we do that, here's some important information for our viewers. Don't miss out on the top 19 must-have stocks for 2023. Subscribe to Money Control Pro for the full list. Welcome back. You're still tuned into Trading Hour, and the market is really cutting its gains. So we're just around 5 points in the green right now. We did briefly slip into the red as well. The Midcap index is in the red as we speak, and the market has really moved lower. So this is led by actually some of the big metal names. Those will come up for you. There's been quite a drop over there. So whether you look at Tata Steel, Hindalco, JSW Steel, all of these seeing some cuts. You're also seeing cuts come through in Ultratech and Kotak, which have seen quite a slide. Kotak Mahindra Bank, that is, in the past few minutes. But that's what's going on with the markets. Let's bring Mitesh in right now for a technical check. Mitesh, we have seen quite a slip right now, absolutely at the flat line. Where do you see it trending from here?
Yeah. So, my understanding is that the market might not trend in the next couple of days. I think maybe as we approach the January expiry, some kind of directional move will kick in. But for timing, it's contracting between 18,000 to about 18,000. 175, 180, that's the near-term range, and probably 17,800 to about 18,250. So I think we still don't have a clear directional signal. So I think the market is likely to chop around in a narrow and contracting range. I think that's the kind of outlook we have on the index. But yeah, clearly trading with stock-specific biases, I think that's where the action is.
Okay, so tell us where the action is at the moment, Mitesh. What are you looking at in terms of individual stocks?
Yeah, I think LTIM, that's a stock, which after many few days of consolidation is trying to break on the upside. The pivot is at about 43.40, so it's staying very close to that. So buy about 43.40, and then I think, look at a target of around 44.50 or thereabouts on the upside. And the stop loss should be about 42.80. So IT names is clearly, on the focus. The other stock which I like is M&M Finance. Good intraday charts here. So buy here with the stop at about 233 for targets of 245.
Mitesh, thank you very much for joining in. For the markets, just up a sliver, up 10 points on the Nifty, but holding above 18,100. Get into a break. We'll come back with more. Welcome back. Today is the day Reliance Industries reports its numbers, but numbers come out late towards 7:30, 8 p.m. But to prep you up and tell you what the expectations are from the oil to chemical business, Sonal is standing by at the big wall. Sonal.
Well, oil to chemicals business in Q3 for Reliance Industries is expected to see an improvement. It will be driven on a low base, and EBITDA is expected to see an increase of 12% on a sequential basis, majorly led by their refining business. So this time around, refining margins are expected to see an increase of 14% on a sequential basis to come in at $16 per barrel, and this will be led by improvement in cracks. So middle distillate yields and also naphtha cracks, they have grown on a quarter-on-quarter basis globally as well. Low windfall tax is something that will aid earnings as well, because that is something that put pressure on earnings in the quarter gone by. Moving on, if we talk about the petchem business, that was weak last quarter, and weakness is expected to continue for two reasons. One, because there are capacity additions in China, and also globally there is a demand headwind as far as petchem segment is concerned. But if we look at the EBITDA, which declines on a sequential basis in the quarter gone by, this is expected to see an improvement. But let's talk about the petchem segment, because it did see a decline in the last quarter, expected to continue. But JP Morgan says that margins have likely bottomed out during this quarter, and they are expected to improve from Q4. So that is a positive commentary coming in. Moving on to their oil and gas business, the exploration and production business, that is where higher gas prices will aid earnings for this segment this time around and will drive EBITDA growth, which is expected to grow 46% on a sequential basis for the company because, of course, of higher gas prices. So this segment has been firing on all cylinders in last couple of quarters, and that is something which is expected to continue this time around as well. So overall, O2C and oil and gas, both of them expected to do well in this quarter.
Sonal, thank you very much for that. Now let's talk about the expectation from the telecom business, Reliance Jio. Now it's expected to be a broadly steady performance this quarter, a revenue growth of 2.8% on a quarter-on-quarter basis. This will be driven by an ARPU increase, that's an average revenue or price increase, right? That will be about 1.3%, and the rest will be volumes, which in the telecom parlance would be your subscriber growth. So subscriber growth should be about 1.5%. The subscriber growth, if you look at it on a quarter-on-quarter basis, will be about 6 million. Subscribers will be added in the December quarter. In the month of October, they had added 1.4 million subscribers, but the street anticipates that there will be a pickup, and on the whole in Q3, Jio will add 6 million subscribers. But this will be lower than the 7.7 million subscribers that they added in the prior quarter, and even lower than the subscriber additions in Q1. One of the reasons is the smartphone shipments have been muted. The next leg is pricing, right? Ultimately, your top line is volume multiplied by price. So price increase, which is average revenue per user, is expected to go up by 1.3%, nudging close to 180 rupees. And pricing for Reliance Jio has been increasing for the last 6 consecutive quarters, and this perhaps will be the 7th quarter. EBITDA margins are also likely to expand on a sequential basis, and that's because it will have the benefit of reduction in SUC, spectrum usage charge. If you had purchased spectrum, and Reliance Jio had purchased a lot of spectrum in the recently concluded auctions, the SUC on that would be lower, so the blended SUC charge is coming down, and that will boost their margins. A little technical, but margins are expected to expand, and profits are likely to be up closer to 4,650. The key to track is going to be tariff increase, because the street has been awaiting a tariff increase. In fact, there were a lot of analysts who thought the tariff increase would come in December of last month, but that didn't come through. So there is a bit of hesitancy. So the street is going to be watching out for whether the tariff increase comes through, and that's going to be the big trigger for the sector per se. So that's about, Reliance Jio. But we've got a management waiting by to chat with us. Happiest Minds Technology, that's the Midcap IT company on our radar. The dollar revenue growth has been modest at 2.1% on a sequential basis. Profits and margins slightly muted. We're now joined by the company's Managing Director, CFO Venkat Raman Narayan, and the Executive Vice Chairman and CEO of Product Engineering Services, Joseph Anantharaju. Gentlemen, thank you very much for joining in. Venkat, first question is, your revenue growth at 2.1% is the slowest that we've seen in the last couple of quarters. In the past, you've recorded higher revenue growths. Could you tell us the reason for that? Was it higher furloughs, any one-off impact? Anything which impacted your top line, and what could you guide for Q4?
Yeah. So if you look at it, our constant currency growth has been about 2.8%, Sonia. And you're right, compared to the earlier quarters, it's slightly lower than the 5% that we have had until now. The reason for that has been, we had one lesser number of billing day, and also there has been an increase in the holidays taken by people. So if you adjust for these two, we are back to the 5% plus. But the larger picture is YTD 9 months, we have done 26% growth year over year. And on the profit front, we are at 26% compared to the guidance of 22 to 24%. So both on the revenue front and the profit front, we are ahead of the margins that we had guided for the year.
Okay, ahead of the margins. Joseph, are you seeing any kind of slowdown in terms of growth or any delays in client spending, any delays in decision making?
Not really, Sonia. The period after November in Q3 typically tends to be one where customers start easing up, and that's a seasonal thing that we've seen in the past as well. But outside of that, we've not seen any slowing down. And in fact, our pipeline at the end of Q3 continues to be strong. And in the first 2 weeks of this year and the quarter, we've already had a couple of large deal closures. What we're seeing is that customers are prioritizing initiatives, digital initiatives that have either a strategic benefit in terms of differentiation or helping them with some major benefit in the mid to long term, or projects and initiatives that will give them immediate and quick revenue. So those are getting prioritized right now. That's one trend that we're seeing. The other that we're seeing is that customers, the CFOs, are not releasing the entire year's budget. They're breaking it up into quarterly budgets and giving it to the budget owners, so that there is, the usual case of cost getting front-loaded and revenue back-loaded. They're trying to address that issue as well to make sure that there's flexibility in the way they operate.
Okay, got that. Joseph, since we were talking about growth, I think the revenue decline has perhaps been sharpest in the BFSI space. It's down around 26% versus last quarter. Can you tell us what's going on, and do you expect the pressure on this vertical to continue?
So there are two reasons, actually. The first one is there was one customer who could have been classified either as a health insurance company. Earlier, it was classified as insurance. we moved it into the healthcare space, which will start reflecting as a vertical from next quarter onwards. So that had a pretty large impact. And so you see the other revenues has gone up significantly because we moved it over there. The second is there are a couple of accounts where we had one-time revenues in Q2, which didn't get repeated in Q3. And those have primarily caused the drop quarter-on-quarter basis in the BFSI vertical.
Got it. Venkat, coming back to the point that you made at the beginning, that if I adjust the Q3 performance for revenues for the holidays, the lesser working days, then the growth rate would be similar to what you have clocked in the past, which is closer to 5%. So in Q4, can we expect the company to clock in the historical growth rates of 5%?
We are hoping to do that, Sonia. But the larger point is we are tracking to meet the 25% guidance on revenues for the year. So yes, the hope is that we want to meet the 5% plus number in Q4. But the base keeps increasing, so there will be slight adjustments that one needs to make for that. But largely, it's aligned to the 25% growth for the year.
Okay. So
and we are gunning for it, and we are hopeful of that.
Okay. So this 25% growth is despite the kind of decline that you've seen in BFSI, right? I mean, you're not expecting any further
right.
fall in BFSI, which
That's
could
right. Yeah, we had Joseph talked about the reclassification that we did. Despite that, and the furloughs and the holidays that we had, which was kind of unplanned for in Q3, we hope to cover that up in Q4 and also meet the numbers of 25% for the year. And
okay. What about
maybe even beat that?
Sure. Joseph, what about attrition? I think it was about 20.9% in Q3.
Yes.
Do you expect it to fall?
Yeah, if you see, during the quarter, it fell almost by 3 to 4%. And we're seeing the market becoming a little bit more balanced now between demand and supply. And given the initial trends that we are seeing in terms of resignations in December and November and the early part of January, I think this number will continue dropping. And over a couple of quarters, we should get back to our historical numbers of between 13 to 16, 17% attrition. And that will also help a little bit from an operational perspective.
All right, got it. Gentlemen, we're going to leave it at that today. Thank you very much for joining us and taking us through the outlook for Happiest Minds. So that is the management telling us that, things are likely to pick up maybe in the next quarter on the revenue front. They could see 5%. But Rima, interesting, right? They said that the budgets are coming in quarter by quarter instead of all at one go. So that's perhaps telling in a way.
It is, because it does indicate that the clients are also uncertain. So typically in January, you would release that I'm spending 100 rupees on my tech budget. But now companies are saying, I'm going to spend 25 rupees for the first quarter. Then I will reassess based on the situation. If the client's financials are going to deteriorate in the Jan to March period, who knows, right? The next quarter's budget may be even lower, right? So that uncertainty remains.
Caution is there,
but all the other tech companies that we had chatted with over the last 2 quarters did indicate that tech budgets are not fully finalized yet, and we will get greater clarity only perhaps in the month of February. But need to get into a break?
Yes, let's take a quick break. We'll get you more on the markets on the other side.